Hey, welcome everybody to the 40 Finance channel. Doing a few live streams this week because I really haven't had time to plan out my videos like normal. And today kind of came in. I wasn't sure what I was going to do, if I was going to be able to do a video or not, but we had some kind of fun stuff going on in the sense of choppy waters in the market. I'd say it's a pretty small event. But it makes for good conversation. So I thought I'd jump on today and kind of look at this kind of up and down that we're in right now. The NASDAQ at the time of this is down about a little less than 1.5%. And obviously the riskier or the less fundamental the stocks in the NASDAQ are, the bigger hit most of them have taken. So I thought today I would just go through the board and show you on days like this what are some of the things that I'm looking for, and obviously answer questions as it goes from there as well. So hope everybody's doing good, and let's see what is going on. All right, let me set the screen up as usual, and we'll start over at Yahoo, and right now we've got about 1% off for S&P, Dow 30, NASDAQ is 1.16, Russell another 1%, and oil hanging around 72. So it's not a huge correction or dip or anything like that, but it's notable because we've just been on such an upward cycle lately. We've got 10-year bond at 1.28. That's taken a little bit more of a dip today. I've been watching that relatively closely, and you know, that's going to be interesting in terms of mortgage activity. So that's one reason that I've been watching it. The headline over at Market Watch today, I think, is pretty entertaining. Thursday shaping up as worst day in months for U.S. stocks as bond rally gathers steam. Prior to open, I think we were down, the Dow was down over 500 points, and it's actually started to bounce back since then. So, you know, they were obviously writing these articles with the expectation of a big day, and it looks like, you know, whatever, minus 1%. Not that big of a deal. And if we go really over to the VIX, if I can get there, when I say not that big of a deal, here's what I'm talking about to find my little VIX tracker. All right, so 1899 on the volatility index. And if we go out, let's go year to date. And you can see coming out of the first of the year, don't forget there was elections and all those other things going on. And hold on, let me fix something here. Okay. Thanks for typing in the chat, guys. For a second, I didn't see it, but I appreciate everybody testing it out. Kevin, good to see you. We got Screw College. Kachi Kilippo, if I said that right. Christopher, all good to see you guys. I will get to your questions, but I want to finish my thought on volatility here. So we are up 17% today, which is notable. I mean, that's definitely something you're going to notice across all your stocks. But from a year-to-date standpoint, it's not even the biggest that we've had this year. So Jan 27, we got to 37, and around February 25th, we were in the 28s, and just going back to June 18th and the May 14, 15 sort of correction that we had, that was in the 27s. So this number obviously can go up before the end of the day, but in regards to how it compares, our 1 month chart isn't going to go back very far, but we did have higher volatility on June 18th, for example. So it's far from a disaster by any stretch of the imagination, but what you are going to see Let me scroll down here to, sorry, they have these biggest loser lists. I'll try to squeeze this in. Trending tickers, stocks most actives, gainers, losers. Let's go to the losers for today. See what's in there. I believe that this is, I did not adjust any filters on this. I believe that this is just Yahoo. And I'm trying to, so New Egg at the top. We talked about them yesterday very briefly. That's obviously a meme stock. Let's switch to market cap. Okay, we're going to go in terms of market cap. So what are the biggest companies that have losses today that would actually make this list? Tencent, Rolls-Royce is a penny stock. It's always in there. Alibaba, which it looks like Screw College was asking about. Man, you really do have to start thinking about Alibaba. You know, I don't invest in standalone Chinese stocks, but, you know, how low can it go? It's starting to become very interesting, and my take on Alibaba has always been, in terms of 2020, let me fix this screen, that stupid Yahoo menu bar. You see how that pops up? It's so annoying, and it takes away from what I try to show you guys. But nonetheless, my take on Alibaba for 2021 is that Jack Ma already got his hand slapped. They already got a fine. So the political risk in Alibaba, to me, is not nearly as high as some of the others that really haven't been touched yet. So I would say Alibaba's already gotten their speeding ticket, so to speak, and maybe they're the safest play. Looking at historicals, you certainly in this neighborhood, maybe in March, you could have got a little bit lower, but you're starting to get in this neighborhood of historically cheap. And this is all based on what are the projections going forward. I don't think it's a bad play at all. Now, the one thing I will say about Alibaba, if you are going to buy a new position, and this probably goes for almost any stock right now. So we're down like 1% today, right? Anything that you were really excited about that you thought maybe the price would go lower, I personally think you're going to have that opportunity for any stock, and that includes Alibaba. Not necessarily because they're bad companies, but I've been waiting for signs of weakness, as you guys know. Heck, ever since we took some dips in May that I thought were super healthy, those dips in May shot right back up, and we got a tiny little bit of choppy water today, and I think we'll see more. I think we'll see more, and I'm not talking about doom and gloom crash. I'm not talking about the financial system exploding. I'm just talking about prices being elevated, a little bit of nervousness, weirdness with interest rates. You also have inventory and some of those other things that I talked about before. That's why if I was going to buy Alibaba, maybe today you pepper some in. And there's no way in the world I would buy any stock full bore position today, right? So full bore position, what I mean is, let's just say for me, a huge purchase would be like $5,000. And that would be very, very uncommon. So let's just say I had $5,000 and PayPal dropped to $200, one of my favorite stocks. That's one that I might close my eyes and buy PayPal at 200 without even looking at the fundamentals. I don't think Alibaba's in that range yet. I think that you could see a couple dips under 200 just in this environment, not because of them. I want to stress that. I think the price right now is reasonable, potentially good, but I think that there could be other opportunities, so I'll leave it at that. Let's just go through some quick questions, and I'll get down to the losers a little bit more. Catchy, you threw in some stocks. I don't know if I know any of those. XELA. These might be... Yeah, these are penny, well, not pennies, but smaller. Transaction processing. I'll throw this one on the board because it does kind of have some, what's the word I'm looking for? Fintech game to it. Transaction processing, enterprise information, document management. Not super familiar with this one. However, it's got a very low price point for those who are interested. It does not look like it's profitable yet. Not a lot of coverage in here. So it's hard for me to find a benchmark for this one. So whenever I don't see coverage, you have to rely solely on yourself, right? I'll type it into tip ranks for you, but I have sort of no comment. I don't know what's going on there. XELA, nothing. It's too small. Sorry, too small for this channel anyway. Carve, C-A-R-V. Carver Bancorp. This one, let's go year to date. This one's on fire, 200%. This looks like a potential meme stock, 5-year chart. There's nothing that insinuates that it should be doing anything. No coverage. So this, congrats to whoever got in this. This is definitely a pump meme type thing that we saw with Newegg yesterday. And so I have no recommendations for these stocks, but I'm on board with, man, if you can pull that off, if you can find places where, where they have coordinated these buying attacks, if you will, then that's great. It's just different from what I do on this channel. There's no hate on Neweggs. There's no hate on AMC. I love it, particularly when younger people ride this train. It's just the hard part for a guy like me. I have a family to feed, right? And I have to invest responsibly for the long term. Very hard for me to buy in these stocks because it's more of a day trade application. That's not what we do here. All right. Weekends before earnings. Christopher commenting on today's volatility. I could see that. There's, I think, Jeremy on financial education. I watched one of his last night. I'm not sure how. He was in his garage. He had his yellow Tesla behind him. But he was talking about who he thought would maybe see weakness in earnings. And his opinion was it was the big tech, right? So I think specifically he called out FANG stocks. And he noted that he was targeting mid-cap stocks for the best value right now, potentially small. I don't want to quote him on that. Go watch the video for yourself. I don't know Jeremy, but I do enjoy his videos. And I think I disagree, not necessarily with Jeremy as a whole, but I think that FANG will continue to surprise. He sounded sort of bearish on Netflix, which you guys know I still think is a pretty good value. You want to buy it in the red, a red day for sure, but I think that Netflix will surprise over the course of 12 to 15 months. I think that the demise of Netflix is overstated. Jeremy insinuated that he thinks that the demise of Netflix is accelerated, and that with people going back into the community and into regular worlds, that they'll have some rough times. Remains to be seen. So anyhow, Christopher, your point about earnings, they're not too far away. Let me, just out of curiosity, we usually do the banks first. So I'm just going to look up when JP Morgan's earnings are. By the way, if you're new to investing, Yahoo does a pretty good job of of putting these in, earnings dates, and even if they don't know them, they'll usually put a range. July 13th for JP Morgan. Let's see, Wells Fargo's July 14th. So yeah, 7 days away, 6 days away for most of these. Citigroup, July 14th. So if you figure typically the banks come first, financial sector, and then about a week or 10 days later, maybe 2 weeks later, you get technology. So it should go banks, retail, technology. Let's see. When's Macy's? Banks. This would be retail. Earnings date for Macy's is a long way away. Let's check Kohl's. All right, so retail looks like they're doing late August. Let's check like Facebook. They're July 28th, so we are 20 days away from Facebook. Google hasn't posted yet. Tesla, July 20th. Amazon, July 28th. They haven't posted yet. Microsoft. We'll know pretty quick if Microsoft's July 27th. Anyway, you get the picture. What do I think of earnings this quarter? I think the most intriguing one will probably be travel sector. So the assumption, right, and we talked about this yesterday, the assumption is that airlines, hotels, Expedia's, Booking Holdings, that they absolutely crushed it because this would be the quarter from March, aka spring break, all the way through to include June, aka summer education break for a lot of American families. Will they live up to the expectations? They should beat. The expectation is that they would beat and show very strong economic dollars coming into the system. It doesn't mean it'll be as good as 2019, but they should show a healthy rebound, certainly year over year. What will be the percentage of, say, a Hilton Hotels revenue-wise versus 2019? To me, that'll be very interesting because whatever the spread is on that, and by spread I mean if Hilton made $1 million in 2019 in Q2, and this year they made $700,000, that's a difference of 30%. And if we kind of normalize that across all the hotels and airlines and Expedias and whatnot, we probably have a pretty good idea where those travel stocks are going to fall for the rest of the year. So to me, travel is going to be a huge indicator. Other things that could be a good indicator is going to be the commentary with chip stocks, including NVIDIA, AMD, TSM, and just kind of hearing about the supply chain. Which way is it going? Can customers get all the NVIDIA video cards that they're looking for? I'm not convinced they can. I'm convinced that they, not through NVIDIA's fault, but I'm convinced that there's a lot of money being left on the table. So that's my 2 cents. And then, of course, you know, when you talk about Facebook and Google, what's the health of the advertising world? I have a feeling they're going to do just fine. I know that Jeremy yesterday said that maybe YouTube was way down year over year on views, which that probably wouldn't surprise me. I would say that the influx of advertising dollars into the consumer market year over year might be enough to make up for that. Just my 2 cents. All right, let's just do a quick check since we got a busy day. Where are we? And you see some recovery here. Sorry. You got S&P now less than 1%. NASDAQ right at 1%. Russell less than 1%. So we've made gains today since the open. The open on NASDAQ 1443, current at 14,500. So all the doom and gloom, did MarketWatch change their headline yet? Let's check on them. Nope. So this headline is sort of lame now, because you're talking about less than 1%. All right, let me get a drink and we'll go into some questions. Saud, hi there, good to see you. Stonked Up, great name. Baba, nice volume wedge, just YOLO 30 calls for January 300. January 300. I don't do a lot of options. I don't do any options on this channel. And when I do options, it is me throwing darts simply for entertainment purposes. But I like the 300. I'm assuming you got this very cheap. And you got a lot of time. You need things to change, obviously, in the political environment in China. But hey, good for you. If you got the money to lose, why not? And I say money to lose not because I think you're going to lose money, but you have to assume the risk for that, and that was my point there. Christian Radcliffe, I sold my BABA for a loss. Chart has more downside in his opinion. I tend to agree with that statement in the sense that I look mostly at fundamentals, and I would say that historically BABA is not super duper cheap right now. The only reason that I would say that Alibaba is cheap in today's world is because of this type of growth. This is revenue estimated growth this fiscal year and next fiscal year. So anytime you're in the 20s, 20% plus, you are in a special club. And normally, a club like that is going to be expensive. So let's look at NVIDIA. I think we can all agree that NVIDIA has a pretty good premium attached to them. They have plus 49% this year, but even looking ahead to 2023, yeah, they're double digits, but it's only 10%. And I say only, that's still awesome, especially when you're talking about this number, $27 billion. But it's not like, you know, world beater type money. Let's take my friend Netflix. They're in the teens, right? Now they have a premium. I would argue that their premium, it's definitely higher. Let's see what it is before I go comment too far. P ratio is 64. So this is my point. I think we saw BABA forward PE in the 20s. I think the backwards looking PE trailing 12 months was 25. And Netflix actually has slightly less revenue growth than BABA. And this is what you see in tech / growth right now. You see an outstanding premium that is really, really hard for me to wrap my head around as being fair. So just to be fair, anytime that you have that much of a premium built in, the company can do awesome. And that's what I try to say so many times around here. Like Netflix, Alibaba, take your pick. They can have awesome, awesome quarters. Arguably hit expectations, and their stock could still go down because those multiples are so high. And that's what you have to be careful. And it's frankly, it's a goose chase on who does it happen to. So on the Alibaba side, you have the China, the politics, the fines, the government getting involved. And so their multiple cratered, right? Came back into the 20s. Netflix still hanging at 60. All it takes is less interest in Netflix as a growing company, bring that multiple, say, down to 40, right? Which is not necessarily cheap. And the stock goes down a lot. It goes down, let's just do the quick math. If this trailing 12 months P ratio, 64, let's pretend this number is 40. 40 times their trailing EPS, Let's pretend this is $8. 40 times 8 is 320. That's, it's not quite apples to apples because I didn't do the decimal points in here, but you're talking about a $200 risk to the price if that interest level were to fall. All right. Sold Obama, SoFi at 16. Saud, I think you've been asking a lot about SoFi. I don't hate it, okay? I just, 3 to 5 years. Buy it at 16 if you love it. 3 to 5 years is when you're going to make your gains. We looked at it yesterday on the show. There's nothing fundamental about SoFi at its current levels that suggest it should go to $50 this year, for example. Now, does it end up on the Reddit board, like whatever we looked at earlier today that had jumped up so high? Maybe. You guys were talking about, our Choppy was talking about Carve, which blew up today. Does that happen to SoFi? I guess it could. How do you project that? You're probably someone who would have to just lean heavy into the message boards and choose. And that's not the way I invest, but it has made a lot of people rich. I can't even get a price to sales on SoFi, so that's what's killing me. Let me try. Sometimes Seeking Alpha does a good job with that. Earnings, estimates, here we go. All right, so this is a good, let's just skip EPS for a second because this company isn't going to be profitable until 2023. And how many analysts do we have on that? 3. If SoFi turned around tomorrow and hit 12 cents for their fiscal year EPS, which by the way, that news wouldn't come out till January of 2024, your forward P at that point would be 130. And then you see how it could potentially go down from there. On the revenue side, if SoFi hits their estimate of 981, by the way, that's not their estimate, that's an analyst estimate, forward price to sales of 13 for essentially a bank, right? Very, very, very high. Very high. If they have a great year next year, and by great, I mean plus 51%, you're still at 9x. It's hard to get excited on those numbers when, let's pick, I'll try Ally Bank because I don't own Ally Bank stock, but they have the exact same services that SoFi does. And here's that comparison. So if Ally hits their estimate, which is 656, 100% growth, their forward P is 762, right? SoFi in 3 years was 100. Now down here, Ally's cranking in $7.65 billion, much, much slower growth, 14%, but look at the price to sales difference, 2.5x. Okay, so that's how I look at it. And I can't say that with SoFi that you're not better off buying Ally. I'm just going to say that and not be. Now, I'll backtrack in one statement. 3 to 5 years is a whole different game. Can you get SoFi next year for $16 and not have your money tied up and still be essentially in the same valuation spot? Potentially, that's the game. What is the risk if you don't buy it at 16? I would say the risk that we saw right here today is low because at least from projection standpoint, SoFi at $16 next year is still not offering a huge amount of fundamental support for that price. And so, I don't know. It's, everyone has a different way. I'm just telling you how I look at it. Chested came in at WBA. Chested, he has some nice, Walgreens. Chested has a good story that he shared live before about Party City that he got in during the pandemic, I believe it was. Sorry if I'm wrong on that. So WBA, forward PE of 10. This is probably one of the largest retailers in terms of stores in America. I'm making that up. I do not know that for sure. They are under pressure right now from a sentiment standpoint because of what Amazon is doing. They have a potential for negative year-over-year growth, but look at this price to sales. 0.31. This is where the value is on this one, and if I remember correctly, you should have a dividend. Dividend history. 2021, 46 cents per share on $46. So, if you hold this one, this would be considered, in my opinion, a solid income type strategy, right? A solid dividend with a potential for growth strategy. I'm sure this year they're suffering a little bit because of, I'm sure on the pharmacy side. And maybe those sales figures aren't even right and they'll come out flat to positive. But you're probably not going to lose money on Walgreens unless there's an unexpected event, right? Unexpected would be some sort of malware, or what do they call it? Cyber attacks that pop out of nowhere. That happened to me with Smile Direct, and they tanked to infinity. So good pickup there for Chested. Rebecca Cruise stocks, bought mine, match 2020 and keeping them. March 2020. So if you bought them in March 2020 and you're keeping them, you've probably made a good decision. What I will say, and let's bring one up, NASDAQ, look at this. Full bore rebound almost. Now, what I always think is interesting, and maybe I'm right and maybe I'm wrong on this one, this is a weird period because this is lunchtime on Wall Street, and by the way, this is just an opinion, but I feel like the market run, which way it's going to go for the rest of the day, you won't even know until 1:30. I think that this is a stupid period during lunch. And you'll see some ups and downs, but wait till 1:30 if you want a good idea of where we're going to end the day. I'm going to try CCL. I've had love-hate relationship with cruise lines on this channel because I said don't invest in them when they tanked, and some folks got upset, which is fine. I just said that there was better opportunities than Carnival was probably about $8.49 or so, maybe when Rebecca picked it up. We'll just call it $10. So she's up $14 on a $10 buy, which is great. And I agree, if she got in at that price, you might as well just hold for a couple more years, because returning to this point, September, way before any of us knew about COVID, September of 2019, to get back to this $50, I don't know when and if they will, but I think it's pretty fair to say that Carnival to 35 or 40, over the next 15 months is probably realistic. I doubt you're going to get a dividend anytime soon because of their debt load. See how that's going, by the way. Debt was terrible because of obvious reasons. 32 billion in debt, 10 billion in cash, which is good. I think they did some more share offerings and padded that a little bit. Last year's revenue was 140, but nothing sailed. Let's see what this year's revenue is. 3 billion this year. So you got a pretty big debt load when you think about $32 billion in debt, 9 billion in cash, and this year you're only going to do 3 billion in sales if analysts are correct. Now next year it gets a little bit better. But don't forget that this is a full fiscal year. So Rebecca, my 2 cents. First of all, congratulations. Looks like you got an easy win. I'm guessing you got an easy win. And I would say that this is not the time to give up as travel is coming back. I would say that if I'm you and I'm already up, there's more room to run. It could take 15 months. But it looks like next year, from an analyst standpoint, next year is the big winter year, and you can probably expect to see the expectation of a really good 2022 start to come out around Halloween, right? People around Halloween, October-ish, the stock market analysts are going to start casting aside 2021, except of course in retail, because of Christmas. But they'll start to look ahead on companies in October, if they're not already doing so. But in October, they're going to be like, okay, Carnival is probably going to land here. What do we see for 2022? And in that regard, it looks like Carnival has significantly more upside when we reach that point. Man, SoFi questions. Can we buy SoFi today? 3 to 5 years, since I just talked about it. Chachi, absolutely right. He did a quick pump and dump. I'm assuming Chachi's talking about Carve. And if so, congrats. Nice job getting in on that one. Christopher, notice you're a big Subway fan. One of the fastest growing fast food franchises. Will they ever up? So one of the reasons that you might see Subway cups, actually the 2 places near my office here, can you see that in the light? McDonald's. So I do the Warren Buffett breakfast, right? If you've ever watched that video on CNBC, he gets like an egg McMuffin or something every day at McDonald's. I'm actually have a mild egg allergy, so I just get the sausage McMuffin. For no other reason than it's easy. I'm not trying to mimic Warren Buffett here. So McDonald's, and then there's a Subway 5 steps away from my office. So I do end up going there. If Subway were to IPO, would I buy it? It's an interesting time for Subway if you follow the industry, because they obviously opened way too many locations in their boom period of the teens, 2015, whatever. And I think they're starting to scale back, and that's probably good if you own their stock, because typically less stores in today's modern retail landscape, less stores gives you a better opportunity for profitability. You didn't really see that in the 90s and in the early 2000s, but now you're starting to see the concept of add another mall, add another store, add another store. You're starting to see that dry up as people understand, like, guess what? Not every zip code is a good place for a location. Let's chop off the fat and stick with whatever, the Times Square store or whatever store is making the most money. If I had to buy a restaurant stock / food stock right now, I would probably I think the slow burn is McDonald's, and I still think that they have a lot of tricks up their sleeve. I would also kick around Domino's, even though I don't really like their food. I think Domino's really comes out ahead in tech, and they also come out ahead in their franchise support. So that would be one I would consider. And from there, I'd have to dig in. I don't know what to think about like the Dardens and the Outback Steakhouses and stuff. I don't know what to think about those stocks. It's not really something that I would invest in outside of the IYC, which is a consumer ETF based on consumer stocks that would have some of those in there, including cruise stocks, travel, etc. But yeah, I don't know. McDonald's seems like a safe play. I really thought that the Wendy's stock, Wendy's isn't a horrible stock before it got meme status, but when that started to go on the meme world, I thought for sure it was going to blow up. I didn't buy it. But prior to that little blip that they had, Wendy's stock, it wasn't horrible. But you're talking about slim margins. So if you're used to looking at margins for like a Google or an Nvidia or whatnot, your eyes are going to pop out of your head when you look at restaurant margins because they're very thin. And what places like McDonald's, Subway, other types of franchisee situations, Domino's, they can pad their margins because they sell to franchise owners, right? So you got the food margin, which is slim to none, but then all the boxes and the napkins and the cups and the secret sauce and all that stuff, it can add up high at the corporate level, but it makes it tough for franchise owners. All right, Mysterious, APTY, cheapest stablecoin, wrong channel. Derek Ridlin, I'm so sick of premium XXL prices for name brand stocks and whatever huge growth stock YouTube picks. Tattooed Chef, Tesla, just give me Pfizer and Intel. Singles and doubles, I agree with that to some regard. I try my best to do barbell. So it's funny because I would say that the safe side of my barbell is not necessarily the safest play, to Derek's point about Pfizer and Intel. I don't have anything I would call that conservative. The most conservative, in my opinion, would be Visa. The multiple is not value land, but I bought it in an area where I'm probably pretty safe now. I consider Visa, PayPal, Taiwan Semi minus the politics. Those are kind of my safer plays. I actually have very little concern about Etsy as well. Let me just pick off some of my names to compare to Derek. Amazon, those are that's the safe side. That's the bigger part of where I play. And then on the risk side, I balance that. Biggest on the risk side for me would probably be DraftKings. I throw Square as a risk because the multiple, to Derek's point, is outrageous and doesn't make sense. We'll see if they continue to innovate. Little things here and there, such as Rocket, SDC, which is Smile Direct, Palantir would be one that a lot of people would argue is risky, and it sits off to the other side of the barbell. So just to put that on the board, this is by market value in my portfolio. PayPal I consider safe, particularly at the price that I am averaging, well under $200. Visa, Amazon, Etsy. Etsy at the price that I'm at now, I'm not super concerned about it. Amazon at the price I'm at, not super concerned about it. So these are pretty safe. I also have TJX, which I bought 100 years ago, and it's only made $20 a share, but it will be a dividend stock potentially this year, so that's safe. TSM I consider safe. Worst case scenario with TSM, they've got a dividend. TAP, which is Coors Light, I'm up 20 bucks a share. That'll be a dividend stock, so that's safe, right? Risk, the other side of the barbell, as I mentioned, DraftKings, Square. I don't know if Rocket goes down. Rocket's probably in the middle. Palantir, Magnite, PaySafe, Sabre, mostly because of their debt. By the way, you're getting to a time in Sabre that you could get very close to what I thought was a nice bottom around 11. This isn't the March bottom, but I thought it was a good price. Keep your eye on Sabre, do your research. Their whole game is based on travel volume, which of course is increasing, so there might be an opportunity. SDC, 764, I bought this son of a gun at in fall, and they just haven't strung together any wins. And you compare that to the stocks that Derek mentioned, which for his portfolio, Pfizer, Intel, and those have not blown up 100x, but when you combine the dividend with those two stocks, and he talks about hitting singles and doubles, I'm sure that he's beating the riskier side of my portfolio. Rebecca came back and said RCL, she hit at 24, now it's 84, and I think RCL is doing a little bit better on the balance sheet than CCL. When you travel, buy at least 100 shares and you get $100 onboard credit. So there's a bonus. Planning on keeping it for the onboard credit and selling 20 years. Then you're winning, I mean, for sure, right? I can't imagine that you would ever be negative. And hopefully, if you're serious about 20 years, I mean, hell, hopefully in 5 years, you're starting to get a dividend for RCL. Plus, it sounds like you cruise. So can't argue that. That fits very well with your life. DH SoFi Girl is behind you on CMEC. Sorry, I missed it. Chestad, McDonald's near me now allows indoor. Same with me, Cincinnati, Ohio. Pre-COVID, I used to hang out there. Yeah, so I typically walk in the morning and just whatever, or get the crumbs and stuff, leave it at the restaurant before I come into the office. What I haven't done yet with McDonald's is sign up for whatever their new rewards app is that supposedly, I've never had a problem. I don't live in Times Square, so you walk in and service is very fast in my particular location, but on this mobile app, some sort of rewards, and you can just like enter your order, your card's already in, and then you walk in the store. I got to fiddle with that at some point. Michael Burry tweeted, "The mother of all crashes is coming." Interesting. Let's see if I can find that. He was supposed to be off of Twitter, by the way, but I do like to see him. Let's see, Burry. There we go. Latest. What do we got? Michael Burry deleted. It doesn't say. I was trying to figure out if he just said that or not. Can he intentionally? I don't know. I'm not going to get into that. But Burry's an interesting guy. I don't like hang on his every word, but You know, what's interesting with investing, and here's a guy who's made a gajillion dollars, way more. He makes more probably in a day than my entire investment portfolio. But, you know, he hit on one big thing, which was the housing crash. And now he's famous forever, and with good reason, right? Just like Warren Buffett's hit on several things. And then we got in this weird world with COVID, and you started to question a little bit about Buffett when he sold airlines, for example. He stuck with Wells Fargo through their scam. Like to me, he's made some interesting decisions of late, but the big, you know, his big ones are going to cement him in history for as big as they were, right? And I think Burry, you know, he could be wrong every day for the rest of his life. And the average person will only remember the headline from the financial crisis or the mortgage crisis. And so, you know, he's worth following. He said he was getting off Twitter, so I don't know where he came in with that statement. So we have a question about gilt, and I apologize because I can't read Arabic, so I can't say your name. Let's look at gilt. Satellite networks. All right. 1 year. So this looks like it popped off and fell after February, like so many growth stocks did. It does have a positive EPS showing here. Also has a 10% dividend of all things. Let's see if I can read about it. Just trying to squash that in for you guys. Pretty good revenue earnings chart, just eyeballing it. Satellite-based broadband communication, Latin America, Africa, fixed networks, terrestrial infrastructure. Okay, so looks like cloud-based satellite network platform. All right, so, and probably a internet play over time via satellite if they're not in it already. No analysts on this one, no revenue estimates. How long has this thing been live? Wow. It's got a track record dating back quite a ways. Only thing we got is price to sales, which is roughly double what we had in 2019. $162 million in revenue. I don't know if COVID was holding that down. $48 million in the bank. Very, very hard for me to say. Not too bad on the short percentage. I would have to read more, unfortunately. I don't know. So this is a press release that they would have done. These news wire things. This is companies do their own press releases, right? Gillette, whatever. Worldwide leader in satellite networking. Orders of 9 million for support of gateways of low Earth orbit constellations. Not sure. Hard for me to say where the company is going without doing a ton more research because they just have no coverage. What I will say is out of all the small cap stocks that have been thrown at me on this channel, I would say that the metrics weren't horrible. I mean, 3x price to sales. They did have an EPS showing up on the one screen of Yahoo, but that was it. And then you throw in a dividend. I don't know. Place your bets on that one. For me, it would be a blind bet, and I would pass. Fastly and BDSI. Fastly. So Fastly, you always have to be interested in Fastly because they got their butt kicked this year on internet outage, TikTok contracts, and anytime that kind of thing happens with the company, that's when I start to get a little excited because they're on hard times. It looks like 52-week range, 39 to 136. So we're going to have to draw this out a little bit. January 1st of 2021, they reached $109. Somewhere in there, they lost the TikTok contract, I believe, and they reached a low of 47. Now you're at 54. EPS is negative. And it looks like they could have a rough year earnings-wise. Last year, supposedly minus 18%. This year, they'll double it, double the negative. So they're losing more money this year than they lost last year from a profitability standpoint. However, growth is plus 25% projected in the next couple years. Let's see how that stacks up. Price to sales of 20. Back in 2019, you could have got it for half that. $1 billion in cash, $1 billion in debt, $300 million in revenue last year. This one you might have to go for technicals. I would say it's not an obvious win, in my opinion, except for revenue. But the multiple still seems high to me. Let me go year to date. You are trending near the 50-day bottom. You had sort of the death cross there. RSI at 46. You're waiting for a news headline to fix this one. You're waiting for a big contract. That's about it. Do you think they're going to get it this year? Does another TikTok come back in? Does, God forbid, they don't lose contracts on that internet outage that they were supposedly behind? Those are the tough questions right now for Fastly. And when I personally look at it, I don't see a stock that is beaten down quite enough for some of the uncertainty that might still come out. Let's see what the old tip rank says. See what analysts are calling this one. Mostly holds, but let's dig into the details. All right, we have a couple updates. 9 days ago, you got a positive. So this is the kind of thing that can happen. Like news on a beaten down stock can change quickly. That's why I like tip ranks. 9 days ago, you actually get a date from somebody. They're saying hold, but potential up 10%. Lot of holds, man. Lot of holds. It's been 9 months. From a best performing standpoint, it's been 9 months since your last buy. I don't see a wave of good news right yet. But keep your eye on the news wire. Jordan's in. I'm not, so I let off Jordan. I'm not doing every day on this. I didn't have time to do like a full video record, edit, blah, blah, that kind of stuff. But we had a little weakness today, so I wanted to jump back in, and I like it. So you guys tell me too on the live streams that I do kind of irregularly. This has been a hot week, but you know, which do you like better? Where I have to record and I have to edit, but I can kind of like think stuff out a little bit better, or do you just like hanging out? If you go on the statistical view for the channel, typically recorded ones perform better, probably because they're more accessible on demand. But you know, I don't mind. I have a pretty like good comfort level for how I look at stocks. So I don't mind when people throw stock tickers at me, because I just like to show you guys what I look at. And so that you can see, you know, maybe my opinion's wrong, and that's okay. But I tell you, like, hey, here's my opinion, here's why, here's your growth, here's your historics. But what you miss when I get to record is you miss like some of the background bullet points that I'll do for like a Palantir, etc., which I think adds a lot of context. So when people asked, when the person asked about like gilt satellite, that is one where if that person had a bunch of research that gilt was coming in with new contracts or something that I couldn't pick up, then I'd be looking at it straight ass fundamentals and I'd be missing a news story. So that's probably what you miss from the recorded stuff. But I like these two. And I appreciate everybody, you know, stopping by during your lunch break or whatever. Love the live streams way more, says Derek. So that's good. Chess Dad, don't stop the show. Market's recovering. That's funny. Derek likes them because we can interact. Yeah, I agree. Jordan likes both formats. What are the best opportunities? We started to talk about it. I need to go back over there. Let me just, to be fair, see, I try to be fair and go in order. DHBDSI. Did we do this one yesterday? No. And unfortunately, man, no way I could comment on this. I assume this is biotech. And if you've been watching me for a long time, I got nothing against biotech, by the way. But I'm just not smart enough to tell you if these things have a bright future. But just to cover it, specialty pharmaceuticals, chronic conditions, bioerodible. I'm not even going to try. See, this is the problem. I don't know enough about. I can handle Pfizer, right? I can handle J&J because they're so huge that the pipelines are very obvious. But on the small biotechs, it's above me. I'm just not smart enough. I can't pronounce half the words in their investor report. And so I'm not comfortable putting my own money behind it because I just don't know. But there's a lot of money to be made in medical stocks. I would just prefer that I had some sort of background in that world, which I don't. Thoughts on AT&T? Cut their dividend. I'm not big on AT&T, and but I understand with the dividend why people do it. I just don't know what they're doing. I don't know what is the bull case for the future of AT&T. I don't see one. And there's other dividend stocks out there maybe that don't pay as much, but they at least have a plan going forward. If you want to take, was it Derek or Chestad? Somebody was talking about Intel, right? So if you want to bet on a stock that's in a rut right now but pays a dividend and more than likely will over 5 to 10 years produce more in the world of returns, I would choose Intel. I don't know what AT&T's path is to success. Huge company, lots of little dink and dunk business operations. I'm sorry to rip it. It's just not for me. Hopefully that makes sense. TSM, I'm a huge fan. TSM at this price, I'm in at 92. The only reason that I wouldn't scream TSM from the mountaintops is because of the China-Taiwan relations. Now, to TSM's defense, I'm going to put it on. They are coming to America, not the movie. And I think that they will find some political safety when they expand more internationally. You can see the flatness. This is not a plus 50% stock, but it is a dividend stock. And in my opinion, their stranglehold on chip manufacturing gives them a distinct advantage. The price today at $29, or 4P of 29, chip sector is sort of hot right now, so it's not going to be the cheapest you ever get, TSM. But, you know, maybe look for a dip. PEG ratio, pretty good shape compared to where it's been in the past. But 12x price to sales, I don't know. Wait for it to come down a little bit. But I will be holding my TSM for a long time. And if you're interested in TSM, understand that they are manufacturers. They are not retail sellers. So the difference between TSM and NVIDIA is very, very significant. NVIDIA boxes things up and puts them on a store shelf where us, the customer, gets screwed, right? Gets the 50% markup. So NVIDIA can produce, they make a certain amount of margin for producing, and then they make most of their margin on the retail side. And that doesn't even count data centers and whatever, which I know those aren't available at Best Buy, but you know, the corporate America's paying retail prices for their data centers. TSM is in a much slimmer margin. They're manufacturing the pieces, parts that go into somebody else's box for the markup. On the bright side of manufacturing, there's not a ton of people who have the technology that TSM does to manufacture the highest of the high-tech chips. That's why I like them. But, you know, margin is a thing. Look up for TSM, look up Arizona, United States. They're going to build some big stuff out in Arizona, in my opinion. Not immediately, but over the next 2 to 3 years. The U.S. is going to pull some of that political pressure off TSM by helping them expand in the U.S. And that's one thing that Biden's done that has sort of surprised me, I guess, because I don't feel like manufacturing falls squarely within most of what Democrats preach, but I'll give him credit, man. He's brought Intel in and NVIDIA and Samsung, and he's like, how can we make chips here bigger, stronger, faster? Can't do it overnight, as Intel's finding out, but you can have a 3-year roadmap to success, and that's what I feel like TSM is right there. All right, we just got told working from home permanently. What businesses do you think will see a boom? That's a good question. I still like the brand, Zoom's brand. I don't own the stock. It's never been at a fundamental position that I could justify. But if Zoom ever said, let's bring them up. I do not own Zoom, just to be 100% clear. Look at the NASDAQ. Seriously, when I did come on, we were at minus 1%. Chop that in half. Hopefully my interest rates are still going down. I kind of like that. Stupid half screen. See what interest rates are. Still under 1.3. Anyway, Zoom. So Zoom is a profitable company, so there's definitely worse things you could do with your money. 386 divided by, call it $3, you're well over 100 on forward price or forward PE. Definitely cheaper than last year though. Yahoo, which only updates daily, they've got it at 88. That PEG ratio is pretty high. So I don't think Zoom is necessarily a buy here at this particular price. And this is why right here. So the pandemic got them to profitability much faster than they ever thought, right? But this flatness on EPS doesn't do a whole lot for your fundamentals. On the bright side, you could still see growth in revenue plus 20%. I bet you they beat this number. But if I had to do an obvious stay-at-home stock, I'd probably be trying to pick off Zoom at the right time. DocuSign was under $200 at one point this year. Recently, look at that, 180. I felt like that was pretty close to a place where I was going to close my eyes and do it. But now it's back up to the moon, and it doesn't make sense at 290. I don't even think DocuSign's profitable yet. Oh, they are. They got a couple bucks here and there. Outstanding growth rate. But man, how do you buy DocuSign at 290 when your neighbor bought it at 180, right? And somebody else, got it at 192 back in March. It'll come back down. Maybe not under 200 this time, but it'll hit it. It's going to hit a rough patch. But I like DocuSign mostly because of the concept, not even so much stay at home as just like digital documents. I mean, what in the hell? Who would buy a paper company besides Michael Scott these days, right? Sorry, I got an itch. So I think DocuSign is a strong brand within digital documents. I think Zoom is a very strong brand within video conferencing. Zoom needs to get into medical as soon as possible. And I think for DocuSign, to reach the numbers that they're being, to reach $290 fundamentally, they've got to show some epic contract growth. They're slated for it. Can they produce it? We'll have to see. All right. I think that's all the questions, and I'm starting to think about lunch myself. Let's take a last look. First of all, did MarketWatch fix their stupid headline? Their doom and gloom headline still sits there, which is funny. Let me refresh to make sure. U.S. stocks solidly lower. Okay, so we had like worst day in months. That's been changed. I find it entertaining. Let's see what CNBC is calling today. Ad blocker. CNBC is saying, look at Wells Fargo. I cannot get behind that company. Unbelievable. Here's a doom and gloom. Stocks are down. Time to sell. Our VIX, we looked at earlier. VIX is dropping. We were close to 20. Now we're in the 18. So wait till 1:30. Not exactly 1:30, right? But wait till the afternoon. So we're seeing a little rally here at lunchtime. How much money does the world have to throw into stocks right now? How much is left, right? And that's the question. I keep thinking retail people are going to pull some money out to go have fun on a vacation, back to school, back to college, whatever it is. That has proven mildly true in mid-May, but it certainly has shot back up from there. So we'll see how it goes. But anyway, good to see you guys. Have a great day. We'll see you on the next one.